Hey there, it's Kyle again, and today I'm going to be chatting a little bit about some frequently asked questions that we receive. And maybe some of these questions have been rolling around in your mind based on some of the strategies and the content that we do share on the podcast. As many of you may be aware, if you've been here a while, one of the tools we use, again, always want to be careful here. We're not saying investment, but tools that we utilize in order to provide optionality, specifically when you are an incorporated business owner, is a permanent insurance policy. In particular, a very specifically designed high early cash value policy. And we do this to create optionality. And I met with a client, actually a listener of the podcast who is also on our email list. If you're not on our email list, make sure you head to CanadianWealthSecrets.com and get on the email list. We send at least one email a week with some tips and tricks and ideas on how to maximize the use of your RSP, your tax-free savings account, or other types of buckets. And we really strategize around how do we optimize our situation. And specifically with business owners, not only for business owners, but oftentimes business owners in particular are super, super helpful to be utilizing a permanent insurance policy, just like you're going to see in today's discussion. And actually, this is some questions from Mark. And Mark met with me on behalf of him and his spouse. His spouse is an incorporated business owner and has a very low risk tolerance. So that's really important for us to note here. So while we typically focus on utilizing our high early cash value permanent insurance as a tool, usually as like a pass-through structure, whether it's at a personal level or at a corporate level, in this case, it could actually be even utilized as an investment because, what Mark goes on to say here, he says, thank you. I continue to follow your podcast and emails, which is awesome. So awesome to hear that. Thanks for the content. He says, the reason that we haven't pulled the trigger on the whole life insurance strategy is, one, it's for my wife who is conservative and struggles to wrap her head around the strategy and the unknown. So there's a couple things to note here. It's definitely not super common. So that is really important to note. So the strategy itself, when we buy corporate owned life insurance, there's a lot of factors that sort of go into this. But I want to pause before we even talk about the strategy and let's talk about conservative investments. So this particular individual from our conversation typically invests in very, very conservative, balanced type funds or in GIC-like assets, which in reality is essentially the same types of returns you're going to receive from a high early cash value permanent insurance policy. So while 80% of the conversations that we have with people who are listening to this podcast, I'm guessing his spouse doesn't listen to the podcast because typically more creative, more think outside the box types individuals listen to podcasts like ours on Canadian Wealth Secrets and on strategy and so forth. So his spouse is actually the opposite. They're thinking like, how do I just make sure that I don't lose any money here? And that's one thing that we know and we can feel very, very confidently about when we talk about permanent insurance, specifically high early cash value permanent insurance, is that it will never go backwards, which is fantastic, right? So this money is going to go in there and it's only going to go up. And there are guarantees, but on top of the guarantees are what they call the dividend scale, which is what helps this policy to continue growing and compounding over time. So a lot of conservatism, a lot of being conservative in this particular strategy. When you're just funding a policy in general. One of the benefits for our business owner friends is that the actual death benefit, which will pay out down the road, which again isn't something that's going to help you like now, the death benefit, but it does actually resolve a lot of problems down the road in that I don't have to worry about pulling all of the money from my corporation and getting high tax, getting taxed in high tax brackets. Throughout my lifetime, I can actually allow this asset to grow inside the corporation and I can decide what to do with it at that point. Do I want to leverage the policy for additional assets? Do I want to leverage the policy and actually take an income in a traditional sense out of the corporate structure? Or do I want to actually look to personal leverage strategies and take those personal leverage in order to actually take cash flow without necessarily triggering any personal income. There's different approaches that can be used, but what we do get is optionality here. So that's a really important piece here. So around strategy and unknowns, actually understanding that is going to be really key. We have yet to meet with Mark and his spouse. So I'm going to argue with anyone out there, you're not going to have any sort of luck if you're trying to convince a spouse to do something and they're not involved in the process, right? So if they're feeling anxious, it's probably because they actually don't understand what's happening. So I would encourage that they hop on a call, and it's likely many calls, so that they understand the strategy, they understand what the goal is, and that it's clear so that they can feel confident. Now, the other one was the unknowns around the landscape 15 plus years from, down the road. That is something that no matter what you do with money, that is an unknown that will not be solved, right? We don't know where GIC rates are going to be. We don't know where the stock market average rates of return are going to be over the next decade. We don't know any of those things. But one thing we do know, if we utilize a strategy like this one, is that you are not going to see that value go down. It will only go up. Now, there is a little bit of unknown there because we don't know exactly what the dividend scale will be 15 years from now. But now, if we're talking about funding this policy, right? Funding the policy, yes, we still don't know what it's going to be like 10 or 15 years down the road. But the key is designing a policy so that there is a early enough offset, which means where you can stop paying premium and keep the policy and allow it to continue growing and compounding so that that death benefit does pay out down the road and does what it's supposed to do, while leaving the door open for leverage strategies against the cash value. That's going to be the key here. So they go on to say, Mark goes on to say, the biggest barrier for him and them is the commitment of a specific amount to contribute each year. They typically have 50,000 to 100,000 of retained earnings every year, but they need to have access to that money for unscheduled large expenses. So what I want to talk about first is that money needs to go do something, right? We can put it under the corporate mattress. We can put it in 3-month GICs or maybe 6-month GICs. But again, if that money is needed, they're going to have to actually withdraw from those types of accounts. What you're probably not going to do is put it into a mutual fund or an ETF or anything in the markets, because if that money might need to get pulled for whatever reason, you might be in a bad part of the market, a bad part of the cycle, which obviously is why people won't do that. So then the question is, where do we put this money? Now, we can put it into a savings account, right? Go ahead, put it in the high interest yield savings account. Right now, it's actually not that bad to do that, right? Like, it's not the worst thing in the world. However, inside of a corporation in particular, passive income tax is so high that you lose 50% of the upside. That is a real issue, that if I get a 5% GIC, which is getting harder and harder to find as rates continue to fall. I'm recording this in December 2024. Tomorrow, we anticipate another rate cut from the Bank of Canada, given all of the jobless claims and unemployment is up, and we have all kinds of other things going on. Well, guess what? As interest rates go down, GIC rates are going to go down along the way as well, which is problematic over the longer term. But the problem is, you get 5% on a GIC, you're really only getting 2.5% inside the corporation. So the logic here would be that in a scenario like this is actually a perfect situation where you might consider, if you have routine retained earnings coming in, and you typically are just investing in very conservative and very liquid type assets, money market funds, saving account, GICs, things that you're going to lose half the upside anyway, right? So that's going to have a massive, massive impact on any type of growth of that capital. What we can do is we actually fund a policy that's designed so that the upside is there, so that there's a high amount of premium that can be added, but you have a low downside or a low minimum amount as well. With $50,000 to $100,000, an example could be having a policy where you can max fund up to $100,000. You don't have to do that, but you could. If you could predict every single year you're going to get between 50 and 100,000 of retained earnings each and every year like clockwork, then it's a no-brainer. We put 100,000 in each and every year. And if you do max fund for about 5 years, the way we design this policy, and I say about because if dividend scales change, this might change a little bit. But as of today, if everything stayed the same, what we're going to be looking at is a minimum funding amount of about 5 years, I always encourage people to think longer term. I always think of a 10-year runway. So if you know that offsetting at around year 5 can happen if we're max funding, then anything after that is going to be just a bonus. All right. Now they do add and they ask and they say, I know you've presented a range with a high and low contribution amount. That's actually not me that does that. It's how the policy is designed. If we want it to be early high cash value so that you have access to as much of the premium that you're putting into that policy via cash value through loans, we actually have to design it this way. And the reason why is that all of that extra amount above the minimum is actually what we call paid up additions. So basically what it is an optional amount to buy more insurance each and every year. And the vast majority of the dollars we put in of the optional amount actually helps to impact how much cash value we have. If we minimum fund this policy for the rest of time, it's going to be pulling harder on the death benefit rope, which is not what we want with this particular policy design. So said another way, if I knew that I was only going to contribute a maximum of $50,000 each and every year for the rest, for 5, 10, 15 or longer years, and I had no ambition to put a dollar more than 50,000, I would set the maximum to 50,000. And therefore the minimum is going to be somewhere around 15, maybe, 18-ish, something in that range. It depends on your age, your sex, all of those things, right? So with that said, the example that I likely used with this individual, because they have 50 to 100,000 in retained earnings, is if there's retained earnings sitting and you want this retained earnings growing, but you want it liquid where you can leverage against the policy should you need the money for business or emergencies or other situations, a permanent insurance policy is a great fit. Now, for other business owners, I'm not talking about Mark and his spouse here because his spouse is conservative, so they're not going to be looking to do this. But for other business owners, they might be looking to invest that money. So they put the money in the policy first as a pass-through structure and then leverage against the policy in order to make the investment they were planning to make anyway. It could be real estate inside the corporation, could be ETFs, it could be whatever they choose. Now you have money working in two places at once, plus the actual pass-through structure, this death benefit, this policy that we've constructed. Essentially, the day we die, it will grow in value. There's no other asset class that does that. This one does. So it's like you get a bonus along the way. Now, if you unfortunately live a shorter than average life, then you get a massive bonus, right? Which is not something we want to happen. But if it did happen, I've never heard a family say, shoot, they had too much death benefit. It's like you're getting this bonus that will help and essentially create legacy and a higher estate value along the way without interrupting your current plans. For Mark and his spouse, they're probably not going to be using leverage, at least in the interim. They might use leverage down the road where they start to draw against this policy so that they can actually use and create cash flow in their life. We have strategies and structures to help them do that in a tax efficient way. However, for other people, in the meantime, while they aren't pulling this money for income, let's say, because this policy size, 50 to 100,000 of retained earnings isn't going to be enough to immediately leverage for any type of cash flow or anything like that. What we can do is we can leverage against it for other asset purchases. For myself and John, we typically leverage against our policies when we get real estate opportunities and we invest it in the real estate. And then any cash flow that's created from that investment will actually funnel back to the policy loan simply to refill the bucket again. At the same time, what we have is exposure to equities, and we have essentially a built-in fixed income type asset. For those that are all conservative and want all fixed income, they could literally just keep piling into this policy. They have the flexibility and the liquidity to access that capital to do whatever it is they choose with it. And they do not lose any of the upside of that passive income from these more fixed income type assets in their corporation to passive income taxes, which is massively hindering the actual growth of that capital. So hopefully that's helpful to answer some of these frequently asked questions. Here he was saying, for example, if our upper limit's 40,000 and our lower is 15,000, why do we need the upper limit? Well, you only need the upper limit if you plan to utilize the upper limit. And I guess what I would say is, like, if your upper limit is really 15,000, if that's your plan, then we're going to design the upper limit to be 15, because that's going to have the greatest impact on cash value. And your lower value is going to be somewhere around $5,000. So it really depends on what the plan is. But with every plan, having flexibility is really helpful. So here, if they wanted to do a $50,000 per year goal, and the challenge is the other 50,000 is now in GICs or other assets that are attracting passive income, they're losing half of the upside. It's actually, I would argue, not a great move. What I would rather do is I'd try to get in my mind around how much retained earnings typically do I receive each year. If it's on average $75,000, right? I'm picking the middle between 50 and 100. I might make the maximum 75,000. However, if you have a big year, 150 one year, now it's like you're going to have to wait multiple years to get all of those retained earnings in. The one thing that's really important to note is that every dollar of retained earnings we put into the policy over time is actually deducted off of how much that dollar has to be taxed on the way out of the corporation via the death benefit and the capital dividend account. So every dollar that I leave sitting outside of the policy and every dollar I put in the policy are going to be treated very differently when they come out. Over time, we get to deduct off the actual cost of the insurance on the premium dollars that go in. So your adjusted cost basis on your policy goes down, which means if I fund this thing for 10 years and I live for, 20 or 25 years longer, the cost of the insurance is writing off in the background how much of the retained earnings that I put in the policy need to be taxed on the way out, which means if I fund a policy of $100,000 for 10 years and there's $1.2 million of cash value, and let's say I pass away and the death benefit is $4 million, I may not have to pay any tax on the full $4 million that comes out of the policy. Which also means if I have any policy loans out, whether they're in the corporation for investment, whether I've taken out loans in my life to create tax-free income or cash flow, as I like to call it, I get this money coming out of the corporation in a tax efficient way in order to wind up any leverage strategy that I may have utilized for investment or for cash flow. So hopefully this is really helpful for Mark, but also really helpful for you as the listener, because there are so many reasons why. We actually received some feedback recently from someone who said, all you guys talk about is insurance. And actually, that isn't true if you go and you look at all of our episodes, but we do often bring up insurance as strategies. Why? Because it's the number one tool that we wish we knew about when we started our real estate and our investing journey. So while the Smith maneuver is a great move, it helps you to write off interest against your home. Guess what? The policy is like a mini Smith maneuver machine. The only difference is there's no emotion attached to that machine, whereas there's a ton of emotion attached to your primary residence, and it's what holds people back from doing something like the Smith maneuver. So hopefully this is helpful for not only Mark and his spouse, but hopefully it's helpful for you. And if you're curious to learn more, specifically if you're a business owner and you want to learn more about corporate owned life insurance and all the benefits and our tax optimization strategies, you should sign up for our masterclass. It's a free masterclass program. You can do it in small little chunks and it's all online. You can head to CanadianWealthSecrets.com/masterclass to sign up. Once again, it's CanadianWealthSecrets.com/masterclass. And note that we also have the opportunity for you to reach out to us for a discovery call. Head on over to CanadianWealthSecrets.com/discovery in order to book a call today.